Good afternoon. My name is Kent Scornia, President and CEO of Krilogy, and I'm here with my partner, John MacArthur, Chief Investment Officer here at Krilogy. And this is your August market perspective. Johnny, good to be with you.
Nice to be here before Labor Day.
Quick stats. Well, I guess a month ago you were discussing sort of giving a preview of the year end and what does it look like, or at least going into the end of the third quarter. And I surmised it as volatility.
Yeah.
It sounds like we have some volatility coming, and that's exactly what we've seen over the last month. S&P 500 down 3.5. NASDAQ off almost 2.5, and really mid-cap's been bounced around a little bit off 5.5 points.
Yeah,
volatility is here. Good call.
It's here. You know, we've continued to follow really a pre-election year seasonality script as our Director of Technical Research, Jamie Setley, reminds us. It's followed a really interesting year to date. Pretty on point, which is kind of this flattening, stalling period in the market, ultimately revising higher, we think, over time. But we're definitely in the thick of corrective mode. S&P peak to trough of late has been down 6%, so nothing too damaging. But we're a couple weeks in of seeing more new lows than new highs.
Yep.
Only 5 sectors of the 11 are positive year to date. So not great action. We were, looking back a month plus, we were seeing this kind of expansion. Small caps, mid caps were acting better.
Right. Yeah. Broadening
international
leadership.
was acting better, but it's kind of been more narrowly focused once again. So again, we're just in this range, we think, for the period of time.
And what led us up is also leading us down a little bit. The tech space has been pretty volatile over the last few weeks.
It has been, yeah, it really has been. Those are, of course, your more expensive segments.
Right.
And, given where interest rates and inflationary pressures are, although they've come down, valuations at some point become a little trickier.
So notable trends that you're seeing out there, particularly in the equity markets at the moment?
Yeah, outside of kind of the stalling and market breadth and participation, which is, I think, normal in part. We're seeing from the data side of things, we're seeing the services sector. Granted, it's a short-term basis, but Philly Fed non-manufacturing index, for example, Corky measure. You can't take 1 month for any type of trend, but it's interesting. So far, we've seen recessionary action out of the manufacturing segment of the economy. And, if we look at credit card balances, at $1 trillion and all-time highs, and we see rising energy prices, we see student loans, as we talked about last time, about to restart here. It's interesting to contemplate how much the consumer really has left. And if services slow down, then all of a sudden you see the reignition of the recessionary concerns.
Right. All eyes are on that consumer.
That's right.
Yeah.
Yeah, and for us, it's hard to think that this time is different, and that the traditional accurate indicators don't matter this time. So leading economic indicators down 16 months in a row. All yield curve inversions, whether we're talking about 3-month bills or 2-year Treasury, relative to the 10-year, still inverted. But I think in this day and age of information right here, right now, I think it just takes time to show up. And I think for the here and now, we're seeing strong GDP from deficit spending, and I think it's just delaying some slowdown in the future.
That inverted yield curve is always interesting because it's almost a guarantee that it's a predictor of a recession, but you just never know, and it could be years before the recession.
Terrible timing mechanism. And it's less about, the most commonly used yield curve reference is the 2-year relative to the 10-year.
Right.
So the 2 years at 5% and the 10 years at 4.2 roughly.
Right.
And it's not only that measure, but it's all the other durations that are inverted, and that's typically a really accurate sign. But you're right, it's by no means a timing mechanism.
You don't want to make portfolio decisions based on an inverted yield curve.
Historically, it's not. The recession doesn't arrive until the uninversion happens.
That's exactly right. Yeah. So interest rates are elevated. Mortgage rates are at their all-time highs. All-time for the last 20 years.
Yeah.
Peak rates here for 20 years.
Yeah.
that obviously is going to impact the consumer,
It will.
particularly on any sort of refis or sort of things
Yeah.
along that line. What else are you seeing on the interest rate side?
I think for perspective, real rates have gone from -3 in March of 2022 to beyond 3. So it's just taking current interest rates versus expected inflation going forward, and that's a huge swing, and that is not economically stimulative. Low rates and negative rates certainly are, but increased borrowing costs and less lending, less investment.
That's right.
There's
going to be less economic activity.
You generally just get less economic activity. That's right.
And so on the portfolio side, what are you guys working on this month? What are the adjustments? I know you have made some adjustments.
We have, yeah. We once again have increased duration and treasuries in our portfolio and in many portfolios. So of course, depending on risk and client goals, but lengthened duration. Yet again, we're still in position to do yet another lengthening, but we've made 2 pretty meaningful moves. The 10-year Treasury got north of 4.25 to about 4.3, which retested the October highs of last year, and we just feel like the risk reward there is really compelling.
And the downside risk there is less, right?
Yes. In terms of
as you
investors
lengthen the duration,
experienced.
that's exactly right.
I think if you think about, it's a great question. If you think about last year, we went from 0 to 5 essentially in rates in short order, in an environment where inflation was really the big scare.
Right.
It's much less about inflation and much more about economic strength or weakness on a go forward. And so, if we look at the big equity drawdowns historically, long duration treasuries have provided that meaningful, typically negative correlation to offset equity risk. Of course, we didn't see that last year for anyone that was long duration treasuries because of that. The starting point was so low.
Of interest rates, right? Yeah.
Right. So we really like the risk reward there. I mean, the other thing too is if we think about macroeconomic, and we look at government. Government debt and interest expense on debt. I mean, it's nearing 20% of revenues.
Yes.
At the government level, and it's knocking on the door of $1 trillion, and so that's just not sustainable.
Right.
I don't know where it ends, but it's one of the reasons why we think seeing a 10-year much beyond current levels for a sustainable period of time is just unlikely, because something will inevitably break in that.
And the positioning of that lengthening of the duration helps on the downside, but also creates opportunity on the upside.
It does. Yeah, there's truly a total return potential, not only taking into account current yield, but appreciation potential.
Which is a game that, for a long time we didn't play in the bond market because there was no yield to play.
Yeah, that's exactly right.
Yeah.
It's very different, and it's changed rather quickly.
Love it. So what else are you looking at in the portfolio?
I think mindfulness around less to non-correlated exposures in the portfolio. So long duration treasuries have historically provided that equity risk offset or negative correlation, but in looking at various alternative investments, whether we're talking about private market exposure or even daily liquid public market alternatives. We think there's from a portfolio construction level.
Give us an example of one of those alternative positions.
There's a number of market neutral strategies that are cash flow oriented, that are able to offset or hedge equity market risk. Private market exposures include everything from private credit, really strong cash flows, to real assets, which has not only worked well in the prior few years, but we expect those to continue. You get dampened volatility, you get cash flow, you get less correlation to public stocks. It's just, those are some things that at a high level could make sense for the appropriate investor.
And that's building off the trend that we believe that, volatility probably is here to stay for a little bit.
We think so.
As we're sort of kind of figuring this market out, and the economy sort of bleeds through all that economic stimulus that's been putting into the economy. And
that's a good point. I mean, if you look at the fiscal stimulus, Inflation Reduction Act, 1.7+ trillion in spend, it's truly, I think, continued to push economic growth forward. But when that fiscal impulse stalls or stops,
Right. Can the private sector take over?
Where does the organic growth come from?
That's right.
That point? And I think when we look at valuations from an equity market perspective, specifically if we look at CAPE ratios, so cyclically adjusted price to earnings multiples, it's just basically taking valuation and inflation into account and looking at equities. Whether we look at a 5-year or 10-year number, we're at about 30.
Yeah.
And it certainly can go higher and has in the past. But I think more importantly, when we look at expected returns, when we're at this starting point, it's just generally not great.
Right.
Doesn't mean that this market can't hit all-time highs. In fact, I wouldn't be surprised if that happens. It's not a market timing indicator, but
Correct.
For a dollar invested today, in terms of looking at expected returns out of public equities on a go-forward multi-year horizon, it's a little tougher.
And that leads me to this is not a set it and forget it market.
It's not.
That's right. You have to grind it out. You have to work through the research. You have to
absolutely
make sure
right.
your portfolio construction's on point.
Absolutely right.
And your risk tolerance is on point before you go out and start investing in a market like this.
Right.
Other trends you're seeing? Anything else you want to add?
No, I think those are the key trends. I think continued expected volatility, really a breadth and exposure. Valuations will once again matter. They've mattered a little bit as we've seen this 6% drawdown. If rates, as Chairman Powell stated last week, if they stay higher for longer, valuations will continue to matter. So looking outside of tech and looking outside of the domestic space continues to make sense, particularly if we see dollar weakness on a go forward from a longer term perspective, which we think will happen. It's a tailwind for international investing. And then just being mindful of less to non-correlated exposures from a portfolio construction perspective.
That's amazing. Thank you, John.
And not being tempted by just the short end of the yield curve. Everybody's enamored, appropriately so, with 3-month treasuries, 1-year treasuries, 2-year treasuries, but it's much more opportunistic than that.
Before we wrap up, I think that's a really great point, because if you're clipping off 4.5% or 5%, you can really get almost lazy.
There's a complacency that can take place there, but
and next thing you know,
potentially quick to fall. I mean,
yes.
When we think about potential credit events or tail risk moments,
right,
short rates are coming down. So that 5% plus that exists now can go away fairly quickly.
Right.
That's where the long duration benefits really would kick in that type of moment as well.
I'm glad you brought that up. Thank you so much. And thank you for the opportunity to have this conversation again. As always, it's a great conversation, and we'll see you here in a month. So for John MacArthur, I'm Kent Scorney with Krilogy. We thank you for the opportunity to be stewards of your wealth. As always, please connect with your wealth advisor to talk about any specific topics in regards to your personal financial plan and your personal portfolio. With that, you have a wonderful day. Thank you very much.